Odds have shortened that the Reserve Bank are going to cut their official interest rate to 0.5% at their March meeting next week. Although last year the Reserve Bank signalled its intention to continue easing monetary policy this year, the Reserve Bank held off a rate cut in February because they said the stronger housing market could be inflamed, could be boosted by another rate cut. But things have changed since then. So to understand what the Reserve Bank may be thinking about and the decisions they may make, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Hello, Michael. How are you today?
Good, thank you. So what are your thoughts? What is going on in the minds of the Reserve Bank board and what are they going to do?
Well, as you clearly stated, Michael, there was certainly a shift in sentiment over the last part of last year in terms of monetary policy settings. The Reserve Bank switched from being reasonably positive that there would be an early year rate cut, perhaps followed up by another one by mid-year, to being a little bit more circumspect about the possibility of an early year rate cut. And I think that was because the labour market particularly improved when the data came through from the ABS. Unemployment had fallen, jobs growth had resumed. And from the RBA's perspective, that has been the main game, and that is the labour market. However, latest data last week has certainly shown a deterioration in the labour market. Unemployment rose to 5.3%. Jobs growth wasn't as positive as was expected. And I think that has raised concerns again from the Reserve Bank that the economy is not responding how it would wish it to respond from those rate cuts last year.
Of course, there are other factors as well affecting the world economy and that may impact the Australian economy, in particular, the coronavirus.
Well, we had another set of data out last week, Michael, which reinforced that the impact of lower interest rates has been benign on the economy. And that, of course, was the wage index data, which remained flat, annual wages growth at 2.2%. But concerningly, we did see the public sector wage growth decline to a lowest level on record. Now, as you suggested, with the local data deteriorating, certainly against the set plan of the Reserve Bank, we're now becoming a hostage to outside forces, and that is in particular the impact or potential impact of the coronavirus on the global and, of course, our local economy. And we've seen that in a concrete sense with quite a sharp shakeout in share markets locally and globally. So that's another factor I think that the Reserve Bank will take into consideration for a preemptive early year strike with interest rates falling, I believe, now more likely than not to 0.5% over that March meeting.
Well, the coronavirus is going to affect our students, which is really a great export industry for Australia, tourism, another important industry, and it's going to, in the short term at least, create a low demand for our commodities. And there are also supply chain implications at the moment because we're not able to get goods from China. All this must affect our economy on the downside.
And sentiment is very important too, Michael, and that's, of course, what we're seeing in the share market, and that constrains investment. And in an environment where consumption, domestic consumption, is an issue with that low incomes growth, of course, the last thing we need is another hit to consumer sentiment. But I think that, you know, with a rate cut, the positives are not just stimulating the local economy, but also an impact on our dollar, which has actually been quite under pressure over the last few weeks. I think that's more to do with a stronger US dollar than a weaker Australian dollar. But of course, a rate cut will continue to put downward pressure on our currency, which would be good news for exporters and would help potential negatives in our export sector from the coronavirus, as you mentioned.
On the other hand, a lower dollar increases the cost of imported goods, doesn't it? Such as petrol.
Well, it's a dual-edged sword, of course, Michael. The currency falling rates are good news for exporters, but not good news in terms of the rising cost of imported goods, particularly fuel, although oil prices have fallen quite sharply recently, so perhaps there's an offset there. But there's no doubt that, you know, a higher cost for imported goods particularly those that are used for inputs into our manufacturing process, can have a negative impact. But at the moment, I think the main game is the export sector, which is set to perhaps be impacted by the coronavirus in terms of student numbers and tourism particularly.
We'll have a chance to chat next week after the Reserve Bank decision and explain what was the thinking behind their decision. But currently, a rate cut looms much more likely than only a couple of weeks ago, Andrew.
Absolutely, Michael. And that shows you the fluid nature of, I guess, the economic environment at the moment. But at least Australia has potentially a couple of rate cuts up its sleeve. And of course, that makes sense in an environment where we've seen something coming out of left field, such as the coronavirus.
Thank you, Andrew.
Thank you, Michael.